maximizing tax efficiency. That's a big topic, so we narrowed it down to business entities, employees, and independent contractors are the two sides that I'll do. And I'll welcome you. My email address is todd@carlsonhighlandcpa.com if you've got any questions after the presentation. But my adage I try to tell the clients is pigs get fed, hogs get slaughtered. If you get a little too piggish with your deductions, that could be you with the IRS. Business entities determines liability and filing requirements for taxes, okay? Sole proprietorship, that's just when you're out on your business on your own. Liability is unlimited. Business income and expenses are reported on the individual income tax return, either a Schedule C, E, or an F. The maximum tax rate is 39.6%. You can thank our current legislation and president for that. They jumped up the cuts from the Bush tax cuts, and then they threw on the additional 3.8% tax that may apply for net investment income tax. Partnerships is another type of an entity. It's a liability is unlimited for general partners. That's where you have two or more partners. Limited partners cannot be actively involved in the business without losing liability. And FYI, partners cannot be employees of a partnership and they cannot receive a W-2. And this is also formed or filed on a Form 1065. Partnerships require to file an annual information return, which is Form 1065, but the partnership does not pay any income tax. That flows through on a K-1, the profits and loss to their tax return, which is on line 17 of a 1040. The maximum rate again for this one is 39.6%. And that graduates up, starts at 10%, and that depends on how you file your individual return. If you're single, head of household, married filing joint, or married filing separate. LLC and LLP. LLC is a limited liability company, provides limited liability for sole proprietors. The LLC can be treated as a corporation, which a corporation can file an 1120 or an 1120S. A partnership, which is a 1065, or part of the owner's income tax return. Where on something like that, you can do a joint venture. Yeah, that's the best way to probably explain that piece. So the limited liability company does not have its own tax return with the IRS. It has multiple options on how to file it. Limited liability partnership, depending on the state law, the LLP may provide partners with protection from various liabilities or provide complete liability protection. Limited liability partnership, that is filed on a 1065. S Corporation, which is my favorite entity because that liability is generally limited to the assets of the corporation. But what I like about the S Corp is you can pay yourself a wage. Let's say you're a profit of $50,000 a year. Pay yourself a wage of $24,000, which is subject to self-employment tax and all your friendly taxes. But the difference in that profit, let's say from the $24,000 to $50,000 is $26,000. That only pays tax on the income tax level. Does not pay the FICA and Medicare tax. That's what I really like about that S Corporation. The IRS, they say, well, you can't pay yourself a salary of just zero because you're maintaining that corporation. They do, income and losses, deductions, and credits are passed to the shareholders, and taxes are paid on the individual income tax rates for the shareholders, and they receive a K-1 that flows through to their personal tax return. The S Corporation's maximum tax rate, again, is 39.6 because that flows down to your personal tax return. S Corp status avoids double taxation, which I'll talk about in the next slide. the C corporation status. You pay tax on both levels. Requirements for an S corporation, maximum of 100 shareholders. That's why you'll see your companies like 3M, they cannot be S corporations. They have to pay tax on the C corp level. Shareholders can include individuals, certain trusts and estates. Shareholders cannot include partnerships, corporations, or non-resident aliens. C corporations. Liability is generally limited to the assets in the corporation, and this is filed on a Form 1120. Profit is taxed at the corporation level when it is earned, and profit is also taxed at the shareholders level when it is distributed as dividends and or wages, aka double taxation. C corporation, there is no deduction for those dividends that are distributed. The shareholder cannot deduct the losses personally, and the maximum tax rate is 35% just at the corporate level. Dividends are taxed at the income tax rate of the recipient. That was a little fast. My daughter said to probably slow down a little bit when I was practicing last night in the heat of tax season. And she's in 6th grade, so she's probably a better public speaker than I am. But we'll go with employees and independent contractors, the next issue, which is, it's kind of a hot button topic for the IRS because they want to get their money as soon as they can. Wages are the best way to do that because you're required to pay right away. Where an independent contractor, you don't have to pay until April 15th that following year. Employees, the definition, employer must withhold income taxes, withhold and pay Social Security and Medicare tax. The Social Security tax, that's 6.2% of your wages, up to $113,000 last year, and I think $117,000 in 2014. Medicare taxes is unlimited, that's 1.45%, and the employer also pays that portion too. Employer must pay federal and state unemployment taxes on wages paid. Statutory employees and statutory non-employees, 4 classes of statutory employees. There's also 3 classes of statutory non-employees: direct sellers, licensed real estate agents, and certain companion sitters. Statutory employees, non-employees. Licensed real estate agents are treated for self-employment taxes for all federal tax purposes, including income and employment taxes, if substantially all payments for their services as real estate agents are directly related to sales or other output rather than the number of hours worked, and their services are performed under a written contract providing they will not be treated as an employee for federal tax purposes. Independent contractors. Their earnings are subject to self-employment taxes. The business does not pay any taxes on the payments to the independent contractors in Wisconsin, but in Minnesota, they do withhold a 2% tax on that side of it. We are kind of close to the border, so I wanted to make sure I made that point clear. Look at that fancy stuff there. Employee, statutory, non-employee, independent contractor, how do you decide? How do you make those decisions of what you are? What are the consequences of misclassifying that? Here's my example. Harry Dunn, employee or an independent contractor. He's an experienced tile setter who orally agreed with a corporation to provide full-time services at the construction site. Harry uses his own tools, performs services in the order designated by the corporation according to their specs. The corporation supplies all the materials, makes frequent inspections of the work, pays him on a piece-week basis, and carries workers' compensation insurance on him. Harry does not have a place of business or hold himself out to perform similar services for others. So the question is he an employee or an independent contractor? Anybody got a, Shannon, help me out. Good answer. You didn't look, did you? Okay. He's an employee. Lloyd Christmas, employee or an independent contractor. You guys are kind of getting my humor here with Dumb and Dumber, right? Contracted with Sampson Corporation to complete the roof on a housing complex. A signed contract established a flat amount for the services rendered. Lloyd is a licensed roofer, carries workers' compensation and liability insurance under the business name Christmas Roofing. Lloyd hires his own roofers who are treated as employees for federal employment tax purposes. If there is a problem with the roofing work, Christmas Roofing is responsible to pay repairs. Employee or independent contractor? Perfect. You didn't look either, did you? I appreciate it. Independent contractor. These examples are pretty laid out. It doesn't always happen like that in the real world. Worker classification audits. What can trigger a classification audit? Any IRS audit, regardless of the audit's original purpose. The fund CP 2000 notices, we call them at the office. Wage and hour, unemployment and worker compensation audits. Unemployment claims from workers treated as independent contractors. Using independent contractors who receive few 1099 miscellaneous forms. Filing a large number of 1099 miscellaneouses relative to W-2s. That last one, I think, is one of the keys for our area over here, is if you use the same person all the time in a job, and he may only have 2 W-2s a year, that's one that may trigger something. And it's not always from the IRS. It can be from the state of Wisconsin, is what they're looking for. They want that withholding tax every month instead of the end of the year. So that's one that seems to be the trigger around here. Audit triggers. Discrepancies between W-2s, 940s, 941s, or 944s in the state unemployment forms. A service business with substantial labor in cost of goods sold on a filed income tax return. And make sure when you do file your Schedule Cs that you don't have a negative gross profit. That's also a big flag for the IRS. You'd be surprised on how many times you see that on a Schedule C. Issuing a Form 1099 miscellaneous to someone previously receiving a W-2 or vice versa. 1099 miscellaneous to the same person for several years. I kind of touched on that earlier. And operating a targeted industry such as construction, trucking, professional services, or healthcare. That must be where the money's made. Who can make employee classifications? The IRS, Minnesota Department of Revenue, Wisconsin Department of Revenue, Minnesota Department of Employment and Economic Development, which is unemployment, Wisconsin Department of Workforce Development, which again is Wisconsin's form of unemployment, and then Minnesota Department of Labor and Industry. The 20 factors to determine classification. Rev Ruling 8741 from 1987-1, CB 296. Here are the lists to kind of give you the facts, and maybe I probably should have talked about that a little earlier, but instructions, training on how you train that employee, integration, services rendered personally, hiring and supervising and paying assistance, continuing the relationship, set hours of work, full-time required, doing work on the employer's premises, order or set sequence set. 20 factors continued. Oral or written reports, payments by hour, week, or month, not just by the job, payment on business and or traveling expenses, furnishing of tools and materials, significant investment, realization of profit and or loss, working for more than one firm at a time, making services available to the general public, right to discharge, and right to terminate. Common law rules, Behavioral. Does the company control or have the right to control what the worker does or how the worker does his or her job? Financial rules. Are the business aspects of the worker's jobs controlled by the payer? How's the worker paid? Is he paid weekly, piecemeal, when the job's done? Are the expenses reimbursed? Do they give them a mileage report per se? Who provides the tools and supplies? Type of relationship. Are there written contracts or employee type benefits, pension plan, insurance, vacation pay? Will the relationship continue, and is the work performed as a key aspect of the business? Reclassification of workers. Some of the 20 factors are not as relevant, so the common law rules are typically used. There is no magic combination to classify the worker. No one factor stands alone. The employer has the burden of proof in the determination of the status of the worker. So if you get looked at, you're guilty until you prove yourself innocent on the way you've determined that. Can you assume it is safe to classify a worker as an independent contractor because the worker wanted to ask to be treated as an independent contractor? The worker signed a contract? The worker does the assignments sporadically, inconsistently, or on call? The worker is paid by commission only? And the worker does assignments for more than one company? And the answer is no. If you aren't sure, the IRS has a form SS-8 where you can make a determination of the worker's status for tax purposes and employment taxes and income tax withholding. But by doing that form, you're literally raising your hand and saying, I can't determine it. It's usually going to be that negative result. Business or workers can file the form. Determination from the IRS can take at least 6 months to get, probably longer. Penalties for misclassification. If unintentional and the 1099 issued, the employer must pay 1.5% of the employee's wages for the federal income tax, 20% of the employee's share of FICA taxes, plus the entire amount owed by the employer, unemployment taxes, and penalties and interest. If unintentional and no 1099 was issued, the employer must pay 3% of the employee's wages, 40% of the employee's share of FICA taxes, plus the entire amount owed by the employer, unemployment taxes, penalties and interest, and the employer has no right to recover from what the employee is due to the IRS. If intentional, and the employer must pay full amount of the income tax that should have been withheld, full amount of the employer and the employee shares of FICA, unemployment taxes, penalties and interest, criminal and civil penalties may be issued, and the employer has no right to recover from the employee what is due to the IRS. Not a great scenario. Do you need to reclassify your workers? The IRS has a voluntary program that you can set up, provides an opportunity for the taxpayers to reclassify their workers as employees, and you must meet the eligibility requirements and file Form 8952. What do you get? The employer agrees to treat the class and class of workers as employees for future taxpayers, so they're not going to go back and get you. In the exchange, the employer will pay 10% of the employment tax liability that the worker would have been due on that compensation paid to the worker for the most recent year, not be liable for interest and penalties on that amount paid, and not be subject to an employment tax audit with respect to the worker classification of the worker being reclassified under the VCSP program for the prior years, which is a good thing. The one example that I have in here from TC Memo 2012-233, the Atlantic Coast Masonry. Closely owned S Corporation used independent contractors to furnish labor, materials, and equipment. Taxpayer argued that the workers were hired on a pre-job basis and free to work elsewhere. So the company did not control them and they were properly classified as independent contractors. Court disagreed and ruled that the employee status was appropriate based on the overall facts and circumstances. The company did possess a significant degree of control, demonstrated by its setting of the workers' schedule and approval of their work. The court also considered that the workers did not have an opportunity to profit or bear any risk of loss on work projects. The workers could be terminated at will. Court concluded that the workers were integral to the taxpayer's business and should be classified as employees rather than independent contractors. Be the pig, not the pig. Or be the pig, not the hog. All right? Those are the references that we used. Sorry, but a little fast, but I appreciate it.